All right, today we are diving deep into one of the most talked about numbers in the world of investing, earnings per share, or EPS. Let's get right to it. You've definitely seen those headlines, right? A company beats its EPS estimates or misses on EPS. But what does that actually mean for an investor? Why does Wall Street obsess over this one number? Well, that's exactly what we're going to break down. So, at its very core, EPS is actually pretty simple. It's a way to measure a company's profitability on a per-share basis. It basically takes the company's total profit and divides it up among all the shares of stock. I love this analogy. Imagine a company's total profit is one giant pizza. If you own one share of that company's stock, the EPS tells you exactly how big your slice of that pizza is. Pretty straightforward, right? More profit means a bigger pizza, which should mean a bigger slice for you. So let's start with the big picture. What is EPS really telling us about a company's financial health? The main takeaway is this: a higher EPS is usually a really good sign. It suggests that a company is getting better at making money for its shareholders. And when investors see that, they get more confident, which can, push the stock price up. And that is exactly what you want to see. Okay, so now that we know what it is, let's peek under the hood a little bit and see how this number actually gets calculated. It's not as scary as it sounds, I promise. It's really just a three-step dance. First, you start with the company's net income. That's their profit after all the bills are paid. Step 2, you have to subtract any dividends that are owed to what are called preferred shareholders, because they get paid first. Then, whatever's left over is the profit available to us regular common stockholders. Finally, you just divide that number by the total number of common shares out there. That's it. Now, here's a little pro tip. The number of shares a company has isn't always static. It can change throughout the year. Maybe they issue more shares, or maybe they buy some back. So to get a really accurate picture, analysts use a weighted average of the shares over that period. It just smooths things out and gives a truer number. But of course, in finance, it's rarely that simple. There are a few different flavors of EPS that you really need to know about to get the full story. Let's take a look. You might be thinking, okay, got it. High EPS, good company. Low EPS, bad company. Done. But not so fast. The number we just calculated, basic EPS, is really just the beginning of the story. And here's where it gets interesting. You'll often see something called diluted EPS. This one asks a really important what-if question. What if everyone who has stock options or special bonds that can be converted into stock suddenly cashed them in? Well, that would create a bunch of new shares, right? So that profit pizza would have to be cut into more, smaller slices. Diluted EPS shows you that more conservative, kind of worst-case scenario. Then there's adjusted EPS. Okay, so imagine a company has a huge spike in profit because they sold off a building. That's great, but it's a one-time thing. They can't sell that building again next year. Adjusted EPS strips out those kinds of one-off events to give you a much clearer picture of how the actual core business is performing day to day. Okay, theory's great, but let's make this real. How do investors actually take this number and use it to make decisions? Let's look at 3 different companies. Now, if you just glanced at this, you'd see Company B has a massive net income, over $18 billion. You might think they're the clear winner. But hold on. Look at how many shares they have. Over 10 billion. That's a lot of slices. So, knowing what you know now, take a look. Which of these companies is actually the most profitable for each individual share? Remember, Company C had the lowest total profit, but also way fewer shares. And there it is. Company C, with an EPS of over $3, is the winner on a per-share basis. This is a perfect example of why you can't just look at total profit. But, and this is so important, an EPS number floating in space doesn't mean much. Its true power is in comparison. And this is where EPS becomes a key ingredient for other really powerful tools, like the famous PE ratio. The PE ratio takes the company's stock price and divides it by our friend, the EPS. It helps you figure out how much the market is willing to pay for every single dollar of a company's earnings. It's a fantastic way to start thinking about whether a stock is cheap or expensive. Now, for as useful as EPS is, it is not a magic crystal ball. So before you go all in based on one number, it is absolutely crucial to understand its limits. So here's the deal. EPS is just one piece of a much larger puzzle. Companies can actually make their EPS look better just by buying back their own stock. It also tells you nothing about the stock's price on its own or how efficiently the company is using its money. And remember that pizza slice? Just because your slice is big doesn't mean you get to eat it. The company might reinvest that profit back into the business instead of paying it out to you as a dividend. And that really brings us to the final, most important point. EPS is fantastic for giving you a snapshot of how a company has performed. But as an investor, your eyes are always on the road ahead. So think of EPS as a vital clue, an essential starting point for your research, but definitely not the final word.